Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, in the last week, there's probably only one word that can describe what's been going on, and that is wow. So a hell of a lot has happened in the last 7 days in investment markets. So I'm going to pick through the bones of that on this week's show. Now, if you recall, a week ago, the market was more concerned about Jerome Powell and his second term as the chair of the US Federal Reserve than they were about a new wave of COVID, particularly in Europe. Well, things have changed a lot since then. And the biggest story which swept the feet from under bond and equity markets was obviously the announcement of Omicron, which is the new COVID-19 variant that has 50 mutations and more than 30 on the spike protein that most vaccines target. Now, the speed at which governments moved to impose new travel and domestic restrictions was a result of fears that Omicron could evade the body's immune system and existing COVID vaccines. And the reaction from investment markets was immediate, with bond yields collapsing. And don't forget, that means that bond prices rallied while equity markets slumped as investors rushed to haven assets. Now, if you looked at the 10-year US Treasury yield at that time, it fell below 1.5%, which obviously was good news for bond investors, but it remained above that 1.46% level, which ensured that the recent uptrend in Treasury yields that we've seen since basically the summer had remained intact. Now, that was a key technical analysis point to keep a look at, and that was as of last Friday. Similarly, in the UK, the 10-year UK gilt yield tumbled back to 0.84%, which was a 1-month low in a matter of hours, and the price of oil collapsed 12%, back below its 200-day moving average, which is a particularly bearish sign. And Bitcoin continued its recent fall, and at one point was 20% below its November high. Meanwhile, most developed world equity markets fell between 3 and 5% from their recent highs, and in some cases they were all-time highs just 2 weeks prior. So the markets were spooked, and that was within the first 24 hours of the news of Omicron breaking. And investors were spooked mostly about the economic impact of a new potential vaccine evading COVID variant, that no matter what you held in your investment portfolio last week, you would have taken a hefty blow. Now, the only real exceptions would have been funds exposed to gold and government bonds, but even the former ultimately took a hit this week, as I will come on to later. Now, heading into the end of last week, the market was in the grip of fear, and based on the market's reaction, you would have thought we were back in February 2020. Of course, it's far too early to say either way just yet, especially as the scientific analysis of Omicron has yet to be completed. But even if we are on the precipice of a March 2020 style event, history gives us a hint about what might come next. Now, in 2020, central banks hit the panic buttons and flooded the market with liquidity via quantitative easing and interest rate cuts, which ultimately propelled equity markets to their recent all-time highs. Now, following the news about Omicron, money markets initially pushed back their bets on how soon and how quickly the US Federal Reserve, for example, will raise interest rates. And it was the same for other central banks too, especially in the UK, where in a matter of days, the market began pricing in that the Bank of England base rate would be around 0.75% this time next year, rather than the 1% plus that had been pricing in just days earlier. Moving into this week, equity markets attempted a rebound with bond yields moving higher along with equity markets. And they tried to move on from Omicron, but then Jerome Powell decided to go in two-footed and take the market's legs away, again in a style reminiscent of Vinnie Jones in his heyday. Now, in this week's press conference, Powell made his most hawkish comments on monetary policy since the pandemic began, stating that it was time to retire the T word, as in transitory, which was his word to describe inflation, and that the Fed would need to act to curb persistent inflation and taper QE quicker than planned. Now, the timing of his comments seemed quite strange, coming just as the market is trying to assess the potential impact of Omicron. Indeed, the Fed admitted that Omicron is not yet baked into its economic outlooks. Now, we will find out in the coming weeks and days whether that will likely change. It means that the net result was that Omicron, combined with a more hawkish pivot from the Fed, sent equity markets into a tailspin. Now, the S&P 500 is some 4% lower than its recent high, currently sitting around 4,500. In Europe, the German DAX is down almost 7% from its high 2 weeks ago. Meanwhile, in the UK, the FTSE 100 is flirting with that key level of around 7,000 again. The dollar has rallied, which was bad news for commodities, especially gold, and even supposed havens, with the exception of certain government bonds, were not safe this week. Now, Powell's comments increased the chance that the current bout of equity market volatility might turn into something a bit more worrisome. But as a benchmark, if the S&P 500 falls below 4,500, then it might be time to start to worry a bit more. At the same time that equity markets have been falling, bond prices have rallied as investors increase their bets that Omicron will hit economic growth. Now, the 10-year US Treasury yield is down to 1.4%, which effectively ends the uptrend in bond yields that started in the summer. So that is going to be interesting to see where that goes in the days and weeks ahead. Now, Omicron and the Fed pivot has changed the backdrop, meaning that fear is the overriding emotion in investment markets right now. Where we go from here depends a lot on how dangerous Omicron turns out to be. If the news is good news, then expect a positive response from equity markets. If not, and central banks tighten into a potential slowdown, then things could get ugly. Right now, depending on which indicators you use, equity markets are actually looking oversold. Now, I explained this in more detail to 80/20 investor members this week in my latest research article, which you can read if you sign up for a free trial. Historically, it suggests we are due a bit of a rebound, but we're going to have to wait to see what happens. But right now, markets are on the edge with a number of equity and bond indices, and including sector-based equity indices, sitting at key support levels. Now, this is obviously technical analysis that I'm talking about. It's a bit like the pandemic itself. Will Omicron spark a similar move we saw in February 2020? Much depends on what science tells us about the new variant in the coming days and weeks. If the news is bad, then things could obviously come crashing down. If things do come crashing down, then the Fed and other central banks will likely need to pivot once again. And ironically, investors would probably be quite happy with that based upon history. If it's good news surrounding Omicron, then it could be the catalyst for the seasonal Santa rally, unless, of course, the Fed decides to derail things. So that is it for this week on Damien's Midweek Market. As ever, you can contact me via email, damien@moneytothemasses.com. You can use Twitter, Money to the Masses with the number 2. We're on Instagram, Facebook, TikTok, and of course, don't forget to subscribe to our YouTube channel.